Welcome to the second video on merchandising journal entries from the seller's perspective. In the first video, we reviewed the differences between a merchandising company and a service company. We introduced new accounts to use on the income statement and the balance sheet, and we demonstrated how to record merchandising transactions from the buyer's perspective and how to record transportation costs. This video demonstrates how to analyze and record merchandising transactions from the seller's perspective. In this video, we will analyze and record transactions from the seller's perspective using a perpetual system, which will include journal entries for selling merchandise inventory, using the sales returns and allowance accounts, receiving payment for a sale with a discount, and receiving payment for a sale without a discount. When a merchandising company sells inventory, they must account for the sale, which is revenue. When the seller sells the inventory to a customer, the cost of goods sold account is used to record what the inventory originally cost the seller. This is an expense account. The sales discount account is a contra revenue account. This account is used when a customer has paid their bill within the discounted time as defined by the credit terms. The sales returns and allowance account is also a contra sales account. Sales return pertains to merchandise that is returned by the buyer to the seller, and examples include defective goods, incorrect product, or color. Sales allowance refers to the reduction in the cost of the merchandise sold. An example is a customer agrees to take a defective product at a reduced cost instead of returning it. So what's the purpose of sales discounts and sales returns and allowances? Well, sales discounts are given to buyers to get them to pay their bill quicker. This way, the company can use this money to reinvest in their company. Sales returns and allowance account allows management to track things like dissatisfied customers or poor quality products, for example. So let's say I own an office supply company and I sell calculators. And this month I've sold 100 calculators. And 25 of those calculators came back defective, but I didn't use the sales returns and allowance account. Well, that would be a problem. And it would be a problem because I would have no idea that I had 25 defective calculators. I need that information because that's costing me money. I need to return those 25 calculators to my supplier to get my money back. Let's begin by looking at this example. It's identical from the video where we demonstrated journal entries from the buyer's perspective. In this case, we're going to look at it from the seller's perspective. So, on January 10th, National Grocers, a wholesaler, sold 10,000 boxes of Cheerios to No Frills, a retailer, for $2.50 per box on terms $2.10 net 30 FOB destination. The merchandise had cost $1.25 per box. Now, when you read this transaction, you're looking for a key word. And as soon as you see the word sold, you're the seller. So you're going to be doing journal entries for the seller. So let's talk about the details. So we sold 10,000 boxes of Cheerios at $2.50 per box, and that equals $25,000. Now the cost of the merchandise sold is 10,000 boxes times $1.25, which is $12,500. Now what we mean by that, the cost of the merchandise sold, we, National Grocers, would have had to buy those Cheerios from, let's say, General Mills, for example, in order to sell them to No Frills. And so they cost us money. Now, we didn't receive payment for the sales as we gave terms, so you can see it's $2.10 net 30 FOB destination. So just to recap, we talked about terms in the last video. $2.10 is if the bill is paid within 10 days of the receipt of the inventory, the buyer can take a 2% discount. Otherwise, full payment within 30 days with no discount. FOB destination determines who will pay for the transportation charges, and in this case, FOB destination means the seller would pay. Now, because I haven't included a transportation cost in this transaction, we're going to ignore FOB destination for this particular example. Remember, you are the seller and have sold merchandise. So when that happens, you must do two journal entries. One is to record the sale or the revenue earned, and the second is to record the cost of goods sold at expense. The larger number in this transaction is always the amount for the sale, and the smaller number is used for the cost of goods sold. So let's take a look at this journal entry. Now remember, we gave terms to No Frills, so we're going to debit accounts receivable for No Frills for $25,000 and credit sales for $25,000. And then we're going to record the expense. We're going to debit cost of goods sold for $12,500. Remember, that's what it costs us to initially buy it from General Mills. And we're going to credit merchandise inventory for $12,500 because we no longer have that inventory. We sold it to No Frills. Moving on to sales returns and allowances, as stated earlier in this video, we use this account to record why the inventory has been returned. In our first video, we talked about a debit memorandum where the buyer initiates the request for a return or price reduction from the seller because there's something that needs to be corrected. The seller can also initiate the request by filling out a credit memorandum. Similarly, it is a form filled out by the seller to reduce the buyer's account. And some of the reasons are as follows. There's a return of unsatisfactory goods. Perhaps the goods didn't meet the customer's specification. There may have been an error on the invoice. National Grocers may have charged No Frills $3.50 per box for the Cheerios, and it should have been $2.50. The goods are damaged, or maybe it was just the wrong product that was sent. Maybe they requested Honey Nut Cheerios and we sent them the plain Cheerios. So let's just step away from our example using No Frills and National Grocers for a moment and review 3 scenarios where we would use sales and returns and allowances. So let's say I own that office supply company and I sell business calculators. I sell them for $100 each and they cost me $50 to buy from Texas Instruments. In the first scenario, the inventory is damaged, but the customer will keep it if we give them a 10% discount. So we take the $100 selling price, we multiply it by 10%, and we get $10. We're going to give them a discount of $10. Now, remember, it's not going to go into the sales discount account. It's going to go into the sales returns and allowances account. I'm going to debit that account for $10, and I'm going to credit their accounts receivable or give them cash if they paid cash by $10. In the second scenario, let's say that the calculator that they bought was damaged. There was nothing we could do about it. It's beyond repair. And so the customers returned it to us. So we're going to debit sales returns and allowance for the full price of what they paid, $100, and we're going to credit accounts receivable or give them cash if they paid cash, and we're going to credit that $100. In the third scenario, the customer is going to return a good to us, but it's not damaged and it can be returned to inventory so that I can sell it. So let's say, for example, I sold them a gray calculator and they really wanted a purple calculator because it's a lucky color. So there's nothing wrong with that calculator. It's just the customer's preference. They don't like the color. They don't like gray. So because I can resell it, I need to do 2 journal entries. The first journal entry is going to be recorded as sales returns and allowances. We're going to debit that $100, and we're going to credit accounts receivable or cash if they paid by cash $100. The second journal entry is returning it back to my inventory because I can put it on my shelf and I can sell it again. So that means I have to debit merchandise inventory for what it cost me, and that was $50, and I'm going to credit cost of goods sold for $50. So let's go back to our example about National Grocers and No Frills and review this scenario. So when the goods were being delivered, the forklift driver from National Grocers accidentally ran over and crushed 200 boxes of Cheerios. No Frills will not pay for the damaged merchandise and sends a debit memorandum to National Grocers. So now National Grocers needs to record this in their books. So since the merchandise is crushed, National Grocers gives No Frills an allowance for these damaged goods. So we take the 200 boxes times the $250 per box, what we charge them, that equals $500. So we're going to debit sales returns and allowances for $500, and we're going to credit accounts receivable for No Frills for $500. No Frills is now going to pay their account using the discount. Whenever the seller is receiving payment from the buyer, they must follow the following 4 steps. So the very first step is to check the balance of the account. Accounts receivable. How much does the buyer owe the seller? So remember, they initially bought $25,000 of Cheerios from us, but $500 worth of Cheerios were damaged. So that reduces their account, so the balance owing is $24,500. Now we want to make sure they are entitled to that discount, so we have to check the discounted date. So No Frills intends on taking the discount, but we need to double check that. So they received the goods on January 10th. The terms were 2/10, so I take January 10th plus 10 days equals January 20th. And since today is January 20th, they get the discount. The third point is to calculate the sales discount. So No Frills intends to take advantage of the discount and pay the bill on January 20th. So we take the $24,500 times the 2% and we get $490. And then the fourth step is to record the journal entry. And so we are going to, the following accounts, we're going to record the following accounts: cash, sales discount, and accounts receivable. So accounts receivable is going to be credited for $24,500. Sales discount is going to be debited for $490, and the cash is just the difference between the accounts receivable and the sales discount. So it's $24,500 minus $490 equals $24,010, and that is the amount of cash that National Grocers is going to receive from No Frills. In this example, No Frills did not pay by the discount date, so they must pay their bill in full. So in this case, we're going to debit cash for $24,500, and we're going to credit accounts receivable for No Frills for $24,500. In this video, we analyzed and recorded transactions for sales using a perpetual system, which included journal entries for selling merchandise inventory, sales returns and allowances, receiving payment for sale with discount, receiving payment for sale without a discount. For more information on accounting resources, check out SALS Online. Thank you.